Am I audible clearly? Good morning. Done. Apologies. Now, let's continue further. When we talk about the domestic acquisition means acquiring an organization within our country. Okay? We're not going outside. So, basically, what are the forms of financing that we try to have when we are acquiring an organization within our country? Is it going to be equity shares and government bonds, or when we talk about non-convertible debentures and loans and preferred stock and foreign loans, or offshore special purpose vehicle and capital market funds? See, when we're trying to buy an organization in India, then why do we need to go out? We just don't need to, isn't it? In this case, there is no need to go out and buy something outside. So in this case, can I say that in this case it would be uh, equity shares and government bonds? No need. Preferred stock, foreign loans, not requirement. If I have to go for foreign loans, I would go for foreign loans when I'm trying to buy something outside, not within the country. Then we talk about offshore special purpose vehicle. That's not the point there too. So in this case, it is basically, why don't we introduce NCDs and loans from NBFCs? They are way better option because I'm trying to have loans within India. That is non-convertible debentures and loans from NBFCs. And everyone, next question. In what instances would an Indian acquirer establish an offshore special purpose vehicle? For domestic acquisition within India, to comply with RBI, to secure loans from other Indian banks, and to issue non convertible debentures. What would be the point, everyone? In what instance, what would be the Indian acquirer establish an offshore vehicle? See, Indians also go outside. They will also have a special purpose vehicle. If I want to grow outside India, why would I be just thinking about India only? For example, companies like TCS went up to US even. So basically, what happens is in this scenario, they work in such a manner that they are looking forward towards domestic acquisitions within India. They're trying to acquire an organization within India, right? So when they are trying to nay, this is different. This is special purpose. Offshore special purpose vehicle is if I am in India and I would like to buy an organization which is outside India. For that I will have a special purpose vehicle. Okay. So in this case, when I have to work, when I want to buy an organization outside, I will have to be very sorted about it. How do we become very sorted about it, everyone? I will try to have it for domestic acquisitions within India, to comply with RBI guidelines, to secure Indian bank loans, or to issue non convertible. This is not required. This is not required. You try to develop a special purpose vehicle because RBI has some rules there to comply with RBI guidelines on overseas direct investments. Direct investments means I'm going outside and putting my money in some foreign organizations there. Okay. So basically, if I want to grow my organization, I have to be very clear in which country I'm going, what are the rules and regulations of the organization, how do RBI work, all those things has to be very, very sorted. What must the buyer account in relation to the non-account controlling interest when acquiring a target? Only the goodwill attributable to it, only the non-controlling interest, both the goodwill attributable and non-controlling interest, neither the goodwill nor the non-controlling interest. What must the buyer account for in relation to the non-controlling interest when acquiring a target? Non-controlling interest means having less than 50% there, you know. And what must the buyer think about this when you're acquiring an organization? I'm sorry. So when we talk about this area, in this case, you cannot think only about the goodwill. You cannot think about only the non-controllable liabilities here. I have to think with the broader prospect. I have to think about both the goodwill as well as the other scenario. That is both goodwill attributable to it and the non-controlling interest. So in this case, the answer will come out to be C. Next question. Where is the non-controlling or minority interest shown in the consolidated balance sheet? It is combined with parent's company, it is shown separately from the parent's equity, it is excluded from the balance sheet, or it is recorded as a liability. It is better visible now. What would be the answer in this case? In this case, the answer would come out to be B. It has to be shown separately in the parent's equity. If we talk about this area now, we are talking about the area of non-controlling minority interest. They have to talk about see the non-controlling part has also be to be reflected now. So this would be shown separately. The parent company is going to show that there is a minor company which is existing there. It has to show this as well. What does a firm A need to record in its shareholders equity if it purchases 50.1% of B? So A has acquired B and 50.1%. That means it's a controlling organization. It is basically controlling, and that is majority. It has got 50.1% of the net income, then 100% of the assets and the liabilities would be covered here. So in this case, it would be 50% or 100% or 49.9 or 100% of the firm. See, when you are acquiring more than 50%, the organization, the decision making is all yours, isn't it? So in this case, you are bound to show. You don't have a choice. You have to show 100% of the assets and liabilities of the firm that is acquired and assumed. What should be the decisive factors in mergers and acquisitions according to the information provided? Accounting concerns, tax benefits, core economies or economics of the sale, or legal structure of selling entity. What should be the decisive factor in mergers and acquisitions according to the information provided? See, when we are trying to have a merger, and acquisition, merger means you're trying to merge with another organization, and when we talk about acquisition, it is when you're acquiring an organization. It is basically what are the things that you have to look forward to. Is a factor, because all these are required. But see, accounting concerns become secondary. If you want to acquire the organization, then everything else becomes secondary. So in this case, it would be based upon, see, my organization produces 10,000 units. The other organization produces 15,000 units. Combined, we become 25. This is good. This is what we would want if we capture more of the market. So, for example, I capture more than 25% of the market. He captures around 30% of the market. Combined, we are going 55. That means we are going to rule the market, isn't it? Ruling the market is what we would want, don't we? So in this case, can I say this is going to be the core economies of sale only? That's the point that we are looking forward to, covering or capturing the market. In the context of acquisition, which party is primarily concerned with assessing the tax basis? Buyer, seller, the shareholder, or regulator? The question itself is very interesting because it is talking about acquired assets. Acquired means bought. Bought means the buyer. He is worried about the fact that how is he going to show it in the books of accounts, isn't it? He has to show all this in his books of accounts in a certain manner. So that would be covered here. The answer would be buyer. What does the term tax basis refer to in merger and acquisitions? The price paid for the acquired company, the level at which the assets can be depreciated, the value of the combined firm after acquisition, and market value of the target organization. What does the term tax basis mean? As such, do you know in terms of mergers and acquisitions there is no tax on it? There is no tax on it. What does the term tax basis refer to in terms of mergers and acquisitions? See, the point is tax basis can be based upon the carry forward of losses, or it can be based upon the depreciation of the goods. So, right, if the particular asset was acquired by previous organization, now it is carried on by the current organization. How are they looking forward to it? Because the combined value is not the point. Market value is never the point because you are not looking forward towards the market value. Price paid for the acquired company is not the point too because in terms of shareholders, it is exempt. For the company which is selling it up, for them it can be taxable, but for the buyer it won't be again. That means if I look at the entire scenario, the taxation that is basically creating a problem is the level at which the assets can be depreciated. The coolest part is that if this organization, first organization was using it for 120 days and the remaining days was taken over by the other organization. For example, we have 365 minus 120. We get 245 days here. This makes 360. This is in the earlier organization that was, for example, the amalgamating company, and this has been now taken up by the amalgamated company. So in this case, the depreciation would be charged accordingly. In this organization as well as this organization, it would be differentiated between the two. That's the point regarding the portion of amalgamation in terms of tax basis. The level at which an asset can be depreciated. Which type of transaction is not considered taxable to the shareholders of the target company? Cash purchase of target assets, stock purchase of target assets, equity, or none? See, if I had shares of company A, now I got the shares of company B. This is not taxable. What is taxable is if between the two companies the problem arises when we are having an issue regarding cash purchase of the target assets or stock purchase. Stock purchase is not a problem because you had shares of this company and now you have shares of AB. This is not a problem because you didn't get even a single penny. The moment the cash is paid, the entire taxation thing becomes taxable. The moment there's a cash purchase. If there is no cash purchase, there is no such problem there. But if there is, then there's a problem. For any cash payment, it would all become taxable. For something which does not include cash, the cash purchase, then it will not be. In the direct statutory stock merger, what happens when the acquirer and target boards reach a negotiated settlement? Both the companies, for example, there is a direct statutory stock merger, which is required by the organization there. Done? When we are trying to find the answer, what would it be? Both firms continue to operate independently. The target is merged into the acquirer. The acquirer is merged into the target, or acquirer and target remain separate entities. See, when we talk about mergers, the organizations would be merging together. ठीक है ना? They would be merging together. That means A and B will become AB. So in this case, when we are trying to find out the answer, what would be? What would it be? Direct statutory stock merger. We are having a stock. Statutory means required by law. What happens when the acquirer and the target boards reach the negotiated arrangement? So when they are having this kind of thing, then once the merger is done, then the organization is taken up by the other organization. So the target is merged into the acquirer. Merger means A and B have now become AB. Now, if I had a share of rupees 40 of A, now the company has become AB. Now I'm getting the share. That share is being exchanged for another value of share. What they do is, for A, they can specify for every 4 shares we can give you 1. For B, they can specify for every 5 shares we can give you 1. So based upon this, the shareholder will get the worth, same amount of money. Number of shares can vary, but it is for the same amount of money. When it is for the same amount of money, then can we say in this case there is no movement of cash? So this is something which is not taxable. You know, this will be not taxable. What is the common tactic used by the acquirers to shield? What would be the amount? What would be the amount? What is the most common tactic by acquirer to shield themselves from the liabilities of their targets in terms of the mergers? Cash purchase of the target assets, then statutory cash merger, triangular mergers, or stock purchase of the targets. See, cash purchase, matlab we have to pay ultimately. Then that becomes the entire thing taxable. Then you have statutory cash merger. Statutory means required by law. Anything which has cash involved in case of merger is always taxable. This is not gonna work. Stock purchase of target shares, how can we do that? Only we, if we want to grow further, I want to merge with the other organization in a bigger way, I cannot rely only on this, isn't it? So it would be triangular merger. What would it be? It would be triangular merger, everyone. And everyone, This is triangular merger. Acha, let's talk about this is detail as well. As per the mergers, they have literally specified when it comes to the section 47 of capital gains of Income Tax Act, they have specified that in case of merger is no tax in case you had shares of the previous company converted into shares of the current company. Secondly, all the losses and depreciation, both the things, would be carried forward by the new organization proportionately or on the basis of what they have got. See, when we talk about this era, in terms of shareholding, we have just discussed that when I had share of A, now I've got the share of B, but the amount should be same. Matlab, there is an exchange ratio with this specified. If I am buying at a higher price of if A had a goodwill, A had particular assets worth rupees 10,000, but the point is I am paying them 12,000. That's because A would have a very good name in the market, so I'm paying 2,000 extra because of that. One thing sorted. Then the second point that can come up is 12,000. Acha. Now the point is, if in any case I paid partial, a part of it is given in shares, the part of it goes in cash. The part which goes into cash will always be taxable. When we talk about the previous organization, whatever the losses and depreciation of the previous organization is, it can be carried forward by the current organization. But there are certain points there. More than 75% of the shareholders should continue. It should continue for a specific period of time. It should continue with the same business. Only then these things would be available, because you should not depart from all those things. No? If you continue with that, the spirit of the previous organization is still live. Only then you can keep up their legacies. Otherwise, you are not allowed to keep up the legacies of the previous organization. That is the point regarding mergers and acquisitions. So I think the deal structuring is over. I think after this we'll start with the last particular module D. Then I'll start with hybrid finance. Acha everyone, if you're looking forward towards a particular PDF of these class, I'll be sharing it in my Telegram channel, that is CAIIB Exam 2023 by Niharika ma'am. Niharike. You can find me there. I'll be sharing the particular PDF of this class there itself. Done? So you can get it there. I'll try to share maximum of it as per the particular scenario which I've seen in JIIB. The examination, now they are putting more and more questions. Nothing from outside, but from the book they are going read between the lines. So it is way better that whatever we are studying, we study that in detail. So whatever questions I'll be giving you, I'll be just putting all that details there itself. What we are discussing right now is module C, last chapter. Okay, a series of good number of chapter of module A, B and C are already done. Now we are on module D, that I'll be starting from tomorrow. So if you are going through it, then kindly check it out on the Telegram channel. I'll be just sharing it there itself. Done everyone? So that's it for the day. But before I end my particular session, I hope you have seen our website. For this, what you need to do is you need to go on to our website. How do we go there? You have to look out for www.adda247, or you can actually open up our app as well. For this, what you can do is, let's check it out. Our website if I look at our website, can you see this? You have to go on to the area of JIIB and CAIIB. Click on JIIB and CAIIB. This is our app there. So if you open up the JIB and CIB area, open up the area of CIB November, this is where you will find throughout the period of Navratri you can look forward to it. This is a good time. In since Navratri is going on, you can use the code NAV80 NAV80 to get 81% discount, especially if you are using app. So the Mahapack would be available. Mahapack includes all the subjects, even the electives. All 5 electives are available. All 4 subjects are available. Ebooks are available. MCQs are available. Multiple classes are available. Everything is something that you can look forward to in this specific classes. What you can do is you can click onto the area of our Mahapack. There you will find 132 tests, 970 video lectures, 263 ebooks, 500 hours of live classes are already available. All these things are available for you. If you look forward to it, then kindly check it out on our website or in our app for further details. Right? So all the classes would be available here. The batches are, another batch is just about to start for you as well, so you can check it out. And till then, please keep on preparing. Our Sankalp batches are out. So in Sankalp batch you will find only those 4 subjects. In Mahapack you will find electives as well as those 4 subjects. Okay, so that is all that you can look forward to on our website or on our app for further details. Thank you so much everyone.